Hello everybody, this is Alex Merced and you're watching this class from Greico Financial Training. And today we're going to be talking about common stock. So what's common stock? Well, when you buy common stock, what you're buying is a share of ownership in the company. So you buy a share of common stock, you buy a share of Facebook, you're an owner of Facebook. You buy a share of Twitter, you're an owner of Twitter. And you're able to go vote with those shares. You can go vote in the annual shareholders meeting. You can sell those shares, hopefully at a higher price. If the company has a lot of profits, that company may pay you a dividend at the end of the year. But the bottom line is common stock just means you have a share of ownership in the company. So let's talk more about common stock after this.
Companies need to raise capital in order to bring their ideas to life, to hire employees, to buy equipment, and, well, to make their dreams come true. One way the company can raise money is by selling ownership in the company by selling common stock. When you buy stock, you are buying ownership in the company, and you are a shareholder in the company that has several rights. The right to receive a dividend if it's declared by the company's board of directors, the right to inspect the books of the company in the form of public reporting requirements like the 10K and the 10Q, the right to maintain your percentage ownership when new shares are issued through a rights offering, and the right to vote on certain important matters, such as the issuing of convertible securities, mergers and acquisitions, stock splits, and who sits on the board of directors, although you don't get to vote on whether the company will issue a dividend every year. Regardless of all the rights you have as an owner of stock, people buy stock to make money. Either through growth by buying the stock at a low price and letting the company's profits grow, which will cause its price to grow, allowing the investor to sell it at a higher price, aka growth, capital appreciation, buy low, sell high. Another way stock investors make money is through income, in the form of dividends. So at the end of every year, the company has profits. Its board of directors may decide to give some of those profits to its investors in the form of a dividend. So now let's delve into details and learn some more.
Okay, so that's a story regarding common stock. So we're going to delve into the details, learn a little bit more about common stock. So here we go. Common stock. So again, bottom line is we started a company, we want to raise money. The question is, what do we issue to raise the money? Now we're going to talk about common stock, but we could have also gone the route of preferred stock. We could have gone the route of bonds, but we decided to just issue plain shares of ownership in the company. Okay, so every corporation has three basic types of securities that can be issued to raise money: common stock, preferred stock, and bonds. But most companies in the early days are going to issue common stock, just plain shares of ownership in the company. So again, common stock represents ownership and is considered an equity. Investors buy a piece of the company and a share of the company and are considered shareholders. So basically, you buy a share of Facebook, you're a shareholder of Facebook. You're an owner of Facebook. That's why they use the term equity, because the term equity just means ownership. What's mine? So when you have a share of Facebook, you have a piece of Facebook. But a lot of other people do too. Now, why do people buy common stock? They're not just buying it so they can call themselves an owner of Facebook. They're buying it to make money, and they can make money in a couple different ways. They can make money through growth, through capital appreciation. So this is the whole idea that you buy a stock at, let's say, $10, and then later on the stock doubles to 20. Okay, and you've doubled your money. That's growth. And that's one reason people buy stock. Now, a stock price grows based on the profits of the company. So as the company's earnings grow, or as the market expects earnings to grow, that stock price will reflect that and go up. So that's why people will analyze companies to kind of help predict their future profits. But companies get bigger, eventually they are consistently profiting, and then the calculation becomes a little bit different. Instead of buying the company because I think its profits are going to grow and I'll be able to sell it at a higher price, I want to buy the company because it has those consistent profits and has a tendency of paying those profits to its shareholders in the form of a dividend. Okay, and that's called income. Okay, when you buy a stock, because it pays you a dividend on a regular basis. So if I pay $100 for a stock and it gives me $5 a dividend every year, well, I'm getting a 5% return on my money. So if I have $1 million to invest in a company that pays me a 5% dividend yield, well, in that case, I'm I can live off the $50,000, move to Florida, live off the $50,000 a year, plus a part-time job, let's say, and enjoy a nice retirement over there in Florida. Okay, so generally that's the deal there. Okay, so you always want to think about things in a suitability context. So generally, a growth investor has a longer time horizon because they have to wait for the price to grow, but they're also taking more risks because the stock can go below the price they originally bought it at. So they can, bottom line is they are taking more risk tolerance over a longer time horizon. That generally describes a younger investor who has more time to wait and is willing to take more risk. Because if you lose everything when you're 20, you have the rest of your life to make it all back. While an income investor, they need money now. So that's why they want that dividend that gets paid every year right now. And so they're not waiting too long. And generally, companies that can pay consistent dividends, these are big, large cap companies that typically aren't going anywhere. So it's much safer than buying a growth company. So this is good for the older investor who doesn't have time to wait and really needs to protect their principal, because if they lose everything at 80, they don't have another 80 years to make it back. So as the investor gets older, capital or principal protection becomes very, very important, because the harder it is to make your principal back as you get older. Okay, so again, growth is if you buy a stock low, sell it high. Income is if the company consistently pays dividends. Those are the reasons why people buy common stock. Shareholder Bill of Rights. So when you own a share of common stock, you have certain rights that are yours. That's why we hold these truths self-evident and refer to them as the Shareholder Bill of Rights. Okay, these rights cannot be taken away as an owner of common stock. Now, the first one we're going to talk about is the right to receive a dividend. Meaning, if you own shares and the company decides to pay a dividend, they got to pay you a dividend. They can't be like, okay, we're paying all the common stock a $5 dividend except Alex. That guy doesn't get one. That wouldn't be cool. So the common shares will receive a dividend if the board of directors at the end of the year declares it. So again, they'll take a look and see what kind of retained earnings the company has, what kind of profits they earn that year, and make a decision what's the best use to create the shareholders' value. Because if the shareholders don't get value, guess what? People in the board of directors get voted off and replaced by somebody else. Now, the thing about dividends is that when the board of directors declares them, they're declared on an annual basis. So we'll say something like, it's a $4 dividend for the year. But that doesn't get paid in one $4 payment. Instead, it gets paid in 4 quarterly payments. So every 3 months. So that means every quarter you're getting a payment of $1. So be careful when people talk about dividends to make sure that you know, are they talking about the quarterly payment or the annual dividend. You have the right to inspect the books, meaning every public company has to make certain public reports to the public. Now, those reports come in the form of things like the 10K, which is the annual audited report of the company, telling you everything about the company over the last year. You have the 10Q, which is the quarterly report that's not audited, but tells you about the company's finances and updates over the last quarter. And you also have an 8K, which kind of gives you sort of material events like new product announcements, changes in the board of directors, changes in officers, stuff like that, that gets reported. All this stuff gets reported to the SEC, the Securities Exchange Commission, and they make it publicly available through what they call their Edgar database, which you can just Google online and you can see which companies have filed anything with the SEC. All of it's there for public consumption. So as a public company, the public has a right to this information, because how are they supposed to be aware of the thing that they own if they don't give them the information? You have the right to vote on certain important matters. Now, bottom line is you own a piece of the company, so you have a say in certain things. So you can vote on things like mergers and acquisitions. You can vote on stock splits when a company chops its shares into two. So you had 1 share, now you have 2 shares. That's a stock split. Okay, issuing convertible bonds. So issuing bonds that actually can convert into stock. Well, if all the people who buy these convertible bonds convert, you're going to be diluted. Now, what does it mean to be diluted? It means that if we issue more shares, the shares that already exist are going to be worth less and represent a smaller piece of the company, which isn't really fair to the original shareholders. So generally, anything that may dilute the original shareholders, they get to vote on, like issuing convertible bonds. or issuing convertible preferred stock. Now, what they don't get to vote on is dividends. Why? Because if I asked you, do you want a dividend this year? What are you always going to say? Yes. So we aren't going to ask you because you're always going to say yes. So instead, you do get to vote on the people who make that decision, the board of directors. It's just like government. Do we ask you whether you want to pay taxes this year? No, because you're going to say no every year. But you do get to vote on the people who decide when you pay taxes, how you pay taxes, all this stuff. Okay, you get to vote on your congressmen, senators, etc. So in the same way, the board of directors makes decisions, but you can vote on who sits on the board of directors. But the shareholders will never ever vote on anything regarding dividends. They will not vote on cash dividends when the company gives you cash. They will not vote on stock dividends when the company gives you stock. They will not vote on product dividends when the company gives you product of the company as a dividend. You don't get to vote on any of that. But the board of directors do, and you get to vote on the board of directors. You have the preemptive right. Now, the preemptive right is the right to maintain your percentage ownership to avoid being diluted. So what happens is if the company issues enough new shares, what's going to happen is that they're going to be required to go put that issue of shares up to a shareholder vote. Okay, so because the shareholders have a right to say, I don't want to be diluted. So the only way to get around that shareholder vote, if you issue enough shares, then what happens is that you're going to do a preemptive a rights offering, which means instead of just selling new shares to a bunch of new investors and diluting the original shareholders, you're going to give the original shareholders an opportunity to buy the shares first by giving them a security called a right. And we'll talk more about that in a moment. But the idea is that if you do a rights offering, you, the shareholder, can choose to use these rights that you are given and keep the percentage of the company you already own. So if you own 10% of the company and you use all your rights, you'll still own 10% of the company. Now, another thing, as I mentioned, you can vote for a variety of things. So you cannot vote for dividends, but you can vote for the board of directors. So while here we're using the example of a board of directors, there are different ways for voting for anything you have to vote at the annual shareholders meeting. And the corporation gets to decide which way you're going to vote when they create the corporation. But it's going to be one of these two methods. There's the statutory method, and then there's the cumulative method. Now, in the statutory method, this is generally going to be for shareholders who want to keep the status quo. They like the way things are. Larger shareholders are generally going to have more power. Why? Because it's one share, one vote, so whoever has more shares has more votes. Okay, so it benefits large shareholders. Now, how does it work? The shareholders will receive one vote for each share they own, which must be voted for each directorship to be filled, which could be any voting item, a stock split, a merger and acquisition, whatever, however many voting items there are, you get one vote per share. So if I have 100 shares, there's a seat on the board up for election, I get 100 votes. If there's also a merger on the table, I get 100 votes. I get 100 votes for each voting item on the ballot because I have 100 shares. So example, let's say that this year there's 5 directorships up for election. So there's 5 different elections going on, and I have 100 shares. Well, I'm going to have 100 shares for each directorship that needs to be filled. So 100 shares for the first one, 100 shares for the second one, 100 shares for the third one, fourth one, and the fifth one. I don't get to vote more than 100 shares. I can vote less, but I cannot vote more than the shares that I own. So if somebody has more shares than me, they're going to have more influence than me. Bottom line. Now, in a cumulative method, these are going to be for shareholders who want change. So this is going to be for corporations who want to give their shareholders more room to shake up the company. On that note, that means very few companies actually use this. It tends to benefit or give a little bit more flexibility to smaller shareholders because they can gang up together and have a little bit more power. How do they do that? Well, the way your number of votes is tabulated is different. So the way this works is that the shareholder will receive one vote per share. That sounds like before, but now it's multiplied by the number of directorships to be filled, or the number of voting items. So in this case, they can be voted any way you like. So you can think of it like the Burger King song, have it your way anyway, when you come to Burger King. But what happens is that let's say you're a shareholder with 100 shares and there's 5 directorships. You get 100 shares, so you got 100 votes. But since there's 5 directorships to be filled, 5 voting items, that 100 shares gets multiplied by 5. So you have 500 votes that you can sprinkle however you like. So I could theoretically, if I really care who wins that first seat on the directorship, and I like there's a candidate I really like, me and all the other small shareholders can just use all of our votes on that one candidate and get them on the board. So I'm going to use all my votes for directorship number 1 because there's a candidate I really like. But since I used all 500 of my votes, I have no votes for the other seats on the board of directors. But the idea is, as a small shareholder, I can at least have a little bit more influence in one election than having no influence in any of them. So that still gives me a little bit more power than I had before. So that's the cumulative method. What you're doing is just you can take the votes that you have for other voting items and kind of use it for any voting item. One way to think about it. You can have it your way, anyway. Now the preemptive right. Now the preemptive right is a right to maintain your percentage ownership during an additional issue. Meaning, we issue more shares, we're going to give you the opportunity to buy your percentage of the new shares. So that way you're not diluted. So that way your shares aren't worth less. So that way you don't lose. Okay? You don't have to take advantage of this opportunity, but you can. So the way it works is that as a shareholder, you're going to receive one right for each share you already own from the company. These generally last 30 to 60 days. You'll have this right that says if you use so many of these rights, they'll tell you. So you can use 3 rights, 2 rights, 4 rights. You can buy one new share at a special price. But again, you only got 30 to 60 days to make that decision. Okay? And that price is called the subscription price. So if you use the rights, you're subscribing to the new shares. Now, what can you do with those rights? The first thing you can do is use them. You can exercise the rights. So you use whatever number of rights is required, pay the subscription price, buy a new share. If you use all your rights, you've maintained your percentage ownership of the company. So if I had 10% of the company does a rights offering, I use and I exercise every single right and pay the subscription price for the commensurate shares, then I'm still going to own 10% of the company, period. So if I use all my rights, I'm still going to own the same percentage of the companies I did before. I can let the rights expire. So I can choose, I don't want to spend the money, and so I'm not going to use the rights, and the rights will eventually expire, and I'm just out money because I'm going to get diluted, and I don't have anything to show for it. That sucks. Now, the thing is that the company still needs to sell those shares, so they generally have an investment bank who's on standby, okay, called a standby underwriting. This just means that the investment bank on standby is there in order to exercise the shares if necessary. Okay, to exercise the shares if necessary, or exercise the rights. Take the shares that would have been sold to the existing shareholders and sell them to other members of the public. So they're there to sell the unsubscribed shares for the issuer. And the third thing you can do, so that way you don't lose money, is you trade your unexercised rights. So you take the rights you haven't used yet and sell them to the public. Okay, so that way you at least get your money back for the percentage ownership you're about to lose, and somebody else can use them. So you do have those options. But if the right's going to trade, what is it worth? Well, for every product, traders, analysts, they use different valuation models to kind of figure out what should this thing be worth, because I don't want to overpay for something, and I want to be able to know when I can get something at a good deal by knowing that it's cheaper than what it's worth. So here we're going to talk about one model to value rights. So we're going to talk about the theoretical value of a right. Okay, and how you calculate this will be dependent on whether you're buying the share before or after something called X date. Okay, X date is the date that if you buy the share, you no longer get the rights when they distribute them. So they all announce saying, hey, we're going to distribute rights to shareholders that you can use to buy more shares, but you got to own it by this date called the record date. A couple days before that is something called the X date. So if I don't buy it before the X date, I don't get the rights. So on X date going forward, if I buy the share, I'm just getting the share. I'm not going to be distributed the rights when they distribute them because I got in too late. Okay, so it's kind of like the deadline. So if I buy the stock before the X date, which means when I buy the share, later on when they distribute the rights, they'll give me one because I bought it in time. Then we're going to use what's called the cum rights formula, meaning with rights. So cumulative always means with. So cumulative rights with rights. And the formula here is going to be m minus s over n plus 1. M is the market price, the current market price of the stock. S is the subscription price. So if I use the rights and buy one new share, what price can I buy it at? N is the number of rights I can use to buy one new share plus 1. Okay, so that's m minus s over n plus 1. Okay, so let's pretend that the market price is 18. Okay, and the subscription price is 14. So 18 minus 14 equals 4. Okay, 18 minus 14 equals 4. That'll be the top part, the numerator. Now in the denominator, let's pretend that it takes one right to buy one new share. So 1 plus 1 equals 2. So the denominator is 2. So 4 divided by 2 equals 2. So that means the value of each individual right equals 2. So using those variables in the question, you plug them into the formula, 4 divided by 2, each right is worth $2. Okay? Now the thing is that if you buy the stock after the X date, what's going to happen is that the rights are going to start trading separately from the stock, because now the stock, so the right becomes its own tradable security, still with the value. So how would I calculate the value if they told me it's after or on the X date? I would use the X rights formula. But on that X date, since you're no longer getting the rights, the market price has to adjust for that you're no longer trading the rights. Okay? So 16 minus 14. So what's going to happen is that since the rights are worth $2, the market price will drop by $2. Why? Because you're not getting that $2 right anymore, because it's X date going forward. So now the stock is worth 16. The subscription price doesn't change. So 16 minus 14 equals 2. And now it's just over n. So n in this case is 1. So 2 over 1. The rights are still worth 2. Point being is that the rights are worth what they're worth. They're worth essentially the discount they give you off the market price. And that doesn't change whether it's before or after X date. The formula does, because the circumstances changed, but the value should still end up being the same. Okay, so bottom line is the theoretical value of a right is the same before or after X date. So hopefully you guys enjoyed this lesson on common stock. I'll see you guys in the next video and we'll talk about something else.